Good morning. It's Isabel Reuss from ITASIF. Today we're doing a deep dive in biocapital. Biocapital is a EU project, and we're going to look at green bonds today. We're going to have a general introduction, then we're going to talk about the core contents with a question Q&A at the end. The outline gives you the topics we're going to talk about today. We're going to talk about bonds, types of bond used in biodiversity, the market size, cat bonds, green bonds, and what are ICMA released new guidelines on secondary designation of nature bonds, mini and basket bonds and aggregation, and other EU projects which are relevant to bonds. Just to give you a small idea, I'm Isabel Reuss. I'm Senior Advisor at ITASIF. We are a non-profit association founded in 2001, and our aim is to encourage the inclusion of ESG criteria in financial product and processes. We have a multi-stakeholder association, which includes from banks to asset managers to NGOs to unions, and we are focused on various types of things we do. One is research, the other one is projects. We do policy and advocacy, which we do also together with our European head, which is EuroSIF, which each country has a SIF, and then they conglomerate together under EuroSIF. And we do a lot of advocacy also on regulation, on things that we're seeing pertaining to sustainable finance. We do a lot of training. We collaborate with universities and training institutions and doing training packages concerning sustainable finance. So that's who we are. So let's talk about what we're going to talk about today. We're going to talk about bonds. So what is a bond? A bond is a financial instrument that represents a loan from an investor to a borrower. The investor is called the issuer, and the issuer can be a government, can be a company, can be a region, can be a city, can be a fund, and can be a project also. And that issuer will then borrow the money and pays the investor not only what he borrowed over time, but also a coupon or interest payments upon a set period of time. At the end of the set period of time, the issuer will repay the investor the principal amount, which means the whole loan amount, if you want, the proceeds. It is something that is used very much in capital markets. It is a very liquid type of asset. It is used by a lot of people to invest in. Why is it important for biodiversity? So first, before we go into looking why is it important for biodiversity, we have to look at what makes a bond successful. And normally, a success of a bond is driven by the liquidity, i.e. the ease with which it is traded in the market. How can you buy it? How can you sell it? Then the second one is credit rating, i.e. the risk assessment. And normally this has to do with the credit rating, which is issued either by Moody's, S&P, or Fitch. And it's basically assesses the ability of whoever issues the bond to repay the debt. And the third one is the return, i.e. the yield and the performance. How much is the coupon on it? How much is it yielding for you? And this is a factor of both the overall market of the issuer itself and also of the moment exactly in which it is being traded. Types of bonds that can be used in biodiversity. Bonds are many. The ones we're going to look at today are mainly green bonds and nature bonds and cat bonds. Why? Because those are two instruments that are mainly used in biodiversity. They're very important and they have unique characteristics. You have bonds which are called use of proceeds. Use of proceeds means the money that you get or the issuer gets by issuing a bond is going to be used for a specific thing. The proceeds are going to be invested in something very specific and defined. And this can be green, social, or a combination of both, and then it's a sustainability bond. Or under the green, it can be only for nature, or it can be only for the ocean, rivers, and waters, and then it becomes a blue bond. Then we have event-triggered bonds. Event-triggered bonds are cat bonds. What happens here is that the bond is active, and if an event happens, then the issuer gets paid. If the event doesn't happen, the issuer does not get paid. So it's an event that defines it. Why are they called CAT? Because it's natural catastrophe coverage. We also have use of proceeds, the first one, with performance triggers like the EIB bonds. We'll go into them in a little bit. And we have also sustainability-linked bonds. These are not specific, money is not specifically used for a project, but it can be used for anything within a company. Here we have just listed some of the features of them. I don't want to go through all of them. Some of them I have already mentioned, but I think it is very important to highlight some of them. One of them is the external verification. In a general bond, you don't have, a company issues a bond, you don't have an external verification. In use of proceeds bond, the green, social, sustainable, nature, and blue bonds, you have an independent third party that needs to do what is called a second party opinion certification on it before and during the bond's time. In a cat bond, it is required because you need to do it for actuarial modeling. You need to see how it's been modeled. And all of the other ones also need it. So it's a required one. And I think that's important to really, really highlight the difference between a general bond and a bond used in biodiversity. The impact reporting, you have an impact reporting. You have to report mandatory. And you have a label. You can label the bond as green, as social, as sustainable. You can label it as a cat bond. You can label it as a sustainability-linked bond. And you have regulatory frameworks that apply. In the case of green bonds, it's the ICMA principles or the EU Green Bond Standard. For the cat one is the ILS market regulation and parametric triggers. And for the sustainability-linked bonds, it is the ICMA principles for these. When we look at the market size, because a lot of people say, well, are these bonds really used that much? If we look at only what has been issued until approximately March, June this year, in 2025, the issuance is pretty high already. And if we now look at the outstanding amount, you can see how big the green bond is. The green bond is really, really a large, very large asset class. You're gonna also notice in this market size that the cat bond category is small compared to the other ones. The reason is that a cat bond has a duration, that means the length of the bond, that is normally 1, maximum 3 years, while green bonds and social bonds and sustainability bonds tend to have an average of 7 to 10 years. So when you see the outstanding amounts, it also shows because there is more outstanding because it's longer time outstanding. EIB bonds are very limited because there are not that many of them out there. It is a new type of bond that is being tested to see if it works. So that's interesting. The sustainability-linked bonds took off very fast, but have been a little bit under discussion due to some greenwashing issues they have. But if we look at this from the time frame in which they developed, as you can see, in 2007, the first climate awareness bond was issued. We would call it the first green bond, and it was issued by the EIB. But as you can see, here's where the big parts happened. The green bond principles were published in 2014, And then we had the Paris Agreement. And once the Paris Agreement started, then we started really seeing it take off. So that is important. Then the other thing that you're going to see COVID. COVID had an issuance of a lot of social bonds. That's why you see the increase in 2020, 21, and 22. Those were a lot of them were driven by COVID. Sustainability-linked bonds, as you can see, they were in fashion more in 21 than they have been lately. And there were some accusations due to greenwashing, and that's why they haven't been issued as much. If we look at green and sustainability government bonds, and here the issue is the government, and we wanted to compare how much is the percentage of GDP. It is interesting to see that some countries have not issued a lot of them, and they could issue that because the amounts of what they issue as bond is quite high, but they could issue a lot more green and sustainability bonds, and they haven't done so. If we then look at how big is on the corporate side, i.e. the companies issuing bonds, how much of that is green bonds? And we have seen a steady rise, and now it's 11%. So it is a big market. It is highly liquid. It is structured. It is known. People like to invest in it. So it is something that we should continue looking at. When we look at what were the proceeds, what is the use of the proceeds? When we look at what were the bonds used for, we can see that a lot of them were done for renewable energy and green building, energy efficiency, clean transportation. What we have not seen is a lot of biodiversity. Biodiversity is this tiny sliver high above here at the top, and it's not enough. We could use them a lot more. So let us dive into what are cat bonds. Cat bonds are a parametric insurance instrument that pay out when a predefined trigger has been reached. That means, for instance, you insure against a hurricane. If your trigger is a hurricane level 5, the cat bond will automatically give you the money if the category 5 has been reached. It will not give you the money if the category 4 has only been reached. So it has a very specific trigger. They were developed as a reinsurance instrument, i.e. insurers had too much risk accruing to them, and it was a cumulative risk that was too high. For instance, if an insurer was sitting in a flood zone and they had only insurance from that side, it meant that their probability that if a flood came, they were going to have a cumulative risk which was too high. So insurers and reinsurers used the cat bonds, to access the financial market to de-risk or deleverage. The reasons why people invest in it is different, because a cat bond is completely unrelated to financial market. It has to do with natural catastrophes. And at that point, it makes your portfolio less risky because it's a different asset class. It triggers different things. It has a different risk inside. Now, from insurers and reinsurers, the first ones we saw that somebody else used it were the governments. For instance, Mexico via the World Bank, also Philippines, Chile, they use cat bonds for disaster relief funding, which is quite interesting. Then we had the World Bank also for the Caribbean catastrophe risk insurance facility. And then we started to see corporates, which means companies, especially in the utilities, energy, and infrastructure sector, using them because they are so exposed to natural hazard. So this is a bond that can be used to help cover in the case a natural disaster hits. It is also one of those which IOPA has defined as being one of the instruments that should and could be used a lot more. If we look at the EU Biodiversity Finance Framework and how they fit in with the cat bonds, the biodiversity strategy, you use cat bonds to protect and restore ecosystem from climate shocks. In investment in you, it is structured together with blended finance as a risk transfer layer. You use it to transfer the risk to somebody else. In the Life and Horizon Europe projects, they have pilots for parametric triggers that are triggered to biodiversity loss. For instance, pollinator collapse or fire risk. The Savings and Investment Union is one of those that wants to get European retail investors, i.e. the grandmother with a lot of money in the bank, to invest their cash. And we could use bonds to try to get them to invest. Why? Because a lot of people know what bond is. And if it's issued by a good entity, they would buy something like that. The EU green bond standards align with cat bonds proceeds with taxonomy compliant nature-based solution. So it means that the cat bond is also aligned with the taxonomy. You can create a green bond that is also cat bond. You have to think sometimes outside of the box and try to see if financial mechanisms can be created that combine various ones in one. Use cases, for instance, in the forest fire resilience bonds. The trigger, if a burned area exceeds the threshold in Natura 2000 zones. Payout, funds for reforestation, biodiversity corridor. These are things that EU projects like PISA, FireRes, Life Forest, and CFF are looking at. Wetland flood buffer bonds. The trigger would be the river discharge exceeding safe limits. The payout is for restoration of floodplains and ecosystem. EU projects involved there are, for instance, West Coast, Horizon, MBS cluster, pollinator collapse bonds. Regional pollinator index drops below baseline. That's the trigger. The payout is what? Agricultural transition, habitat restoration. Basically, the agroecological transition means that you use agriculture in such a way as not to damage the pollinators in this case. EU projects that are doing that or are involved in something similar or involved in that are biotraces, biodiff cap eco schemes. If we needed to implement a pathways, this is just some thoughts. This is not something, this is just a general thought. You have to define a parametric trigger, and you can use, for instance, EU Copernicus and biodiversity monitoring systems for data. Then you structure and blend it with EU grants and private capital via Invest EU, and you can use EIB or a national promotional bank as an anchor, as an issuer of this bond. This could be, for instance, a Cade de Depot, Casa de Deposito y Préstito, KfW, for instance. And if they're the guarantor, then it's very easy for the market. The market would buy those bonds because the creditor is very credible. You have to ensure that the policy is aligned on the taxonomy side and on the do no significant harm. And you have to link payouts to actions within that and on nature restoration plans. You have to how to engage with the CIU, the Savings and Investment Union, to build something that can be also sold to the broad market. Why green bonds? And now we switch over. Why green bonds and why green bonds with use of the secondary designation of a nature bond? We have a huge finance gap on biodiversity. We know that. EU household holds significant bond investing. So it is something that EU households know. Bonds are a fixed income investment and can provide portfolio diversification and risk diversification. The European bond market is highly liquid, as I said. It's regulated with frameworks like the EU Green Bond Standard that are transparent to everybody to see. So if we have biodiversity-focused bonds that align with the TNFD, with the EU taxonomy, with the green bonds, with the ICMA principles on secondary designation, this becomes very credible, and it is a highly liquid market in which you can use them. What makes a green bond successful? If we looked at the financials before that, right now, what makes a green bond successful? A green bond is the clear use of proceeds. You know exactly where the money is going. And this also here, as a parenthesis, is something that the young generation really, really likes because they know exactly where the money is going for. You have a green bond framework, and it's either the ICMA one that has a green bond for those that are outside of EU, or you have the EU green bond standard. You have a third-party verification. This is independent third parties, and that's really, really important. You have to report every year, and you have to have regular updates. What are you doing? What is happening? What has been the impact? It is aligned with EU taxonomy. It is aligned with SDG goals. It can be aligned to any of the biodiversity targets you set. So that is what makes the green bond very, very successful. Here, I just wanted to, and I'm not going to go into the detail. I've put a lot of slides and information in the annex, and we also link in the annex to all the material we're talking about. But this is a comparison between what is ICMA and what is the EU. The main difference is it must align with the EU taxonomy. And once you decide to do it, it's mandatory for you to disclose on it. You have to decide before if you want to follow the EU Green Bond Standard or the ICMA one. We have seen a lot of companies already issue EU Green Bond Standards. They became live at the beginning of 2025. So we have seen a lot of issues here. Here are recent bonds that were emitted. You know, the EIB issued its first EU Green Bond Standard aligned bond in 24, raising 3 billion for climate and environmental project. France, Ile-de-France is Paris region. They issued 1 billion green bond standard at the beginning of this year to fund clean transport infrastructure. And Spain issued one for urban mobility. If we go and see on corporate and municipal issuers, you're going to see, for instance, the first financial one that issued one was ABN AMRO, and they supported energy efficiency buildings and circular economy. Then you have A2A, an Italian utility, which issued a green bond for renewable energy. And here, the important thing, biodiversity restoration. So we're starting to see biodiversity appearing, and we should see more of that in the future. Nature bond. Okay, nature bond, this is something that came up in August. ICMA launched in August a secondary designation as a nature bond. What does this mean? This means it's a green bond where 100% of the proceeds are allocated to nature-related projects. These go beyond climate mitigation and address biodiversity directly. And the 4 pillars are the same ones that the green bond has: use of proceeds, project evaluation, management of proceeds, and reporting. They're eligible, the only bonds that are eligible for the secondary designation if they are exclusively fund nature positive activities. They align with the cunning Montreal GBF targets, the taxonomy, the EU taxonomy, the SDGs, and the EU green bond standards. So it's basically you're going to issue a green bond with a secondary designation nature bond, but it's going to be used 100% for nature. they released this practitioner guides in August, and they presented some use cases: forest restoration, wetland rehabilitation, regenerative agriculture, pollinator-friendly farming. And they also said which type of bonds would be allowed under the secondary designation. They also talked about biodiversity metrics and validation, and they emphasized the need for credible ecological baselining, spatial validation, impact tracking, and the use of geospatial tools. So that's where it comes into also linking up to what Copernicus data is bringing us. So this has been something that I think is going to open up a market. We haven't naturally seen any issued because the guideline just came out in August, but we hope to see a lot more because the green bond market is so liquid. By designing it as a secondary designation, it fits under the green bond standard, it falls under that market, it has access to the big financial market of those. How do nature bonds fit with the biodiversity finance? In all of them. It's aligned with all of them. I'm not going to go through all of the details, but it's aligned with all of them. Here, the last topic we want to talk about is mini green bonds and basket bonds. A lot of time projects, but this is not only for projects, this is also for the SMEs in Europe. And we got to remember the SMEs are the backbone in Europe. So mini bonds are medium to longer bonds issued normally by unlisted entities or unlisted companies. It can be a project, but it can also be a company. And it is limited in the size. The turnover, for instance, of the company cannot exceed 2 million. The workforce must consist of at least 10 employees, and you have an annual reporting on it. So it's basically, it is a green bond, but for small people. The problem with the mini bonds is when you go to the financial market, it is too small for the big investors to invest in because they might come to the market with 1, 2 million, and that's too small for an institutional investor to invest. So what happens then is you aggregate them and create a basket bond. It's a joint issue of mini bonds. So you take, for instance, all of the people in a region involved in, we can say, for instance, in waterways, you put them all together, and at that point, you create a basket. The basket is then big, and the basket can be brought to the market and becomes interesting for the institutional investor. And this normally, the basket has a guarantor, and the guarantor is going to be somebody like the Credit Depot, European Investment Bank, InvestEU, Casa Depositi e Prestito, KfW, any of these companies, or banks in these cases, or entities, supernatural entities. This is something that is going to help a lot. And here, everybody has a role to play because it's not only the state, it's the supranational agencies, and these are the Credit Depot, the European Investment Bank, for instance, but it's also the regions. You can have one region, you can have a city, you can have the banks, you can have the asset owners. All of them have to play a role in this one. And you can create and interact between the legislation and how you work within this system to help align and educate and simplify and help SMEs, but also projects, achieve a level of liquidity that makes it interesting for the financial market. Here we have listed some Horizon Europe projects that are relevant in nature biodiversity. I'm not going to go through all of them. They're just what the focus area are, if they have a bond relevance, and what the comparison is to biocapital, because that's the one we're looking at right now. And this is a suggestion like the one I did for cat bonds of a pathway for green nature bonds. Use case structuring, map use cases to the targets and map them to the GBF targets, validate them, use the bond framework, use ICMA's recommended indicators, check also what tailors with the EU green bonds, and then try to see if you can find somebody to structure it with, to give you a second opinion, to be your guarantor for it, because it makes it easier to go to the market with it. And then try to amplify and demonstrate this for better use on the markets. Use case structuring here, I have put in some of what would be the global targets of the Global Biodiversity Framework. And just to show you what type of bonds could be, projects could be using a bond. And I think it applies to all of our use cases pretty easily. You can also use, for instance, impact reporting and verification. This is, some examples. Areas restored, species richness, water quality. You can use a star score. You can use habitat connectivity index, all of those to see if you can do that. And here we have who would be the stakeholder group, the key actors, and the role in a nature bond strategy. Who would you involve? Why would you involve them? And what would be their role? This is just to give you some ideas of how this could be structured within our project. I thank you very much, and I just want to leave you with the annex. This is a paper investigating bond prices' reaction to climate-related events for the cat bonds. Who is ICMA? The comparison again. What is the Savings and Investment Union? And why is it so important for us? We also leave the references here. And this contains all of the literature we use for the preparation of this webinar. We will keep adding to this literature, but just that you can find it, all of the information is available. So I thank you very much, and I leave it open for questions. And should the time run out, I will make sure to schedule a next call to discuss all of this.